An expert. He's Paul Taylor, the President and Chief Executive Officer of Fitch Group, the rating agency. He's based in London, but we're happy to have him in our studio today, this morning. Paul, thank you very much for joining us.
Thanks for having me.
Fitch, I'd love to get your views on the Fed, and we'll get to that in just a moment. But Fitch says globally the pivot by central banks this year will be widespread but not steep. Explain to our viewers exactly what that means.
I guess, first of all, I'm never sure about being introduced as an expert on interest rates, because I'm not sure any of us actually know what's going on with interest rates at the moment. We are seeing the divergence. So we're seeing some central banks starting to cut. So Switzerland, Mexico, Brazil this year so far. And of course, at the end of last year, we all expected the US to come down by up to six cuts this year. We've always said that should be 3, and we've always said it will be a bit later. We're holding to that at the moment. So we do think we peaked in the US. We think it will come down, but clearly the data's starting to put pressure on the Fed to delay those cuts. And
are other major central banks feeling the same pressure? In other words, is inflation proving stubborn elsewhere?
So that's where the divergence is coming in. So I think the GDP numbers last week from the US, the underlying inflation number was still quite challenging. We're seeing inflation in Europe starting to come under control, but the European number is driven by an energy crisis. So I think Europe will see move quicker, the ECB will move quicker on rates than maybe the US. So we are seeing this interesting divergence, which we haven't had for the last couple of years.
I know we saw, Paul, last year Fitch cut the U.S. rating from AAA down to AA+. And obviously there's a lot of concerns with the U.S. government debt. And I'm just wondering if you or Fitch has any concerns about Canadian and the Canadian debt levels that we have here on our side.
Yes, so we did move the US from AAA to AA+ last year, which was a very quiet week for me, as you can imagine. Canada's had a problem with its debt for quite some time. It is going the right way. So, and I'm not a sovereign ratings expert, I should stress, but I know that we took Canada down from AAA, I think, back in 2019. That was driven by the debt levels, which were like 128% at the time. They're now back down to 97% or so. But that's still almost twice the average for the AA medium sovereign credits. So some way to go. That's the biggest challenge for Canada, in fact.
Yeah.
OK, what do you expect in the language from the US Federal Reserve Board on Wednesday?
I think we'll see them holding.
What about the future? What about subtle forward-looking guidance?
Who knows is the simple answer. I think they keep saying they're data-driven. The data's not helping them because it has been challenging. I do think that all the time we have full employment in the US, the employment markets are so strong, we're still seeing consumer spending staying in there, which has been a surprise, frankly. I think until that starts to ease, and it's taken a while for the high rates to come through, particularly in the US housing market where you've got these fixed rate mortgages. So I don't think people are feeling it in the pockets yet, and they're still employed, so they've still got money to spend. So I think that's driving the challenges that the Fed's facing.
Is it possible that the Fed doesn't cut at all this year? As we just noted, the Fed funds futures market is now priced. You have to go all the way out to early November now before you see a 100% probability of a rate cut being expressed. That's almost the end of the year.
So there's certainly a possibility. Last thing I read was there was 20% of economists are now predicting no increase this year. But the economy is still strong in the US. It's been surprisingly strong. This whole talk about a soft landing or no landing is now becoming more prominent. So I think the risks of no decrease are increasing. We still think there will be an increase. That's where the Fed wants to go.
A decrease?
Yes,
you think there'll be a decrease?
Yes,
right?
I do.
Brianne?
I know we have seen some downgrades kind of across the board. Can you share your insights on if you see any certain sectors that might be impacted or that maybe are more at risk than other sectors?
Yes, so one of the interesting things about the current economic cycle is that we're not seeing a big increase in credit defaults and credit risk. Now, having said that, we will see an increase. So this year and next year, if you look at non-investment grade corporates, so anything below BBB minus, if you take a 2-year period, so this year and next year, we think we'll see something like 8% of those credits default. Now that compares to maybe 2% for the last several years. So there is going to be an increase in default risk. But it's important to remember that's well below the normal average for an economic downturn. So it's well below what we'd normally expect in a decline. So yes, there'll be an increase, and there are sectors that are troubled, like commercial property, for example, retail. But we're really not seeing anything dramatic at this stage.
Let's finish with the one developed market central bank actually expected to increase rates and has begun doing so already for the first time in many, many years, the Bank of Japan. What do you expect there?
I think they've just held, haven't they? They've kept where they are. Remember with the Bank of Japan, we're talking about 0.1% up or down.
Yes.
So, we're talking about tiny little movements there. So it's more about direction than anything. Japanese economy is doing quite well. I mean, it's strong. I think it's been 10 years or so, 12 years. They've been looking to get some inflation. They've now finally got some inflation. So, good for them.
I'm an investor in Japan. I like it.
Okay, good.
Thank you so much for joining us. We really appreciate you stopping by this morning.
Thank you for having me.